a series, Greed and Fear, and it gives me great pleasure to bring on board Nilesh Shah. He's a very dear friend of mine. I've always admired him for his stock picking abilities. He's got this knack of picking up mid-cap ideas which really become great businesses. Nilesh, we are discussing a bull market like never before. Where are we headed? It's a bull market which has not seen a correction. It's a bull market which refuses to come down. Are we in for exciting, better, and unbelievable days ahead? The reason I'm asking this question, Nilesh, is because I just want to draw context to what's happened in the last 18 months.
Absolutely, Nikunj. It's been a wonderful time, the last 18 months or so. But I still believe that this is the start of the journey. This is essentially, as you rightly said, another bull market. And I still believe that we are at the start of this round of the bull market. And this is a bull market which is going to last for several years. This is not some kind of a flash in the pan. This is not kind of a bull market which is going to be short-lived. This is not just one ordinary uptrend. These are extraordinary times for India, and I clearly believe that this bull market is going to extend for several years. The challenge that everyone faces really at this stage is to basically just look at how the markets have really kind of risen from the lows of March 20, but that may not be the right way to look at it. We've got to see what India has done over the last 5 years or 10 years as a market, and if you look at it in that context, we're probably still around high single digit or low double digit returns. And clearly bull markets do not end with these kind of returns. Bull markets probably end when the returns are terribly extraordinary over 5 to 10 years. And I clearly believe, therefore, that this bull market is a long way to go. This is going to be a multi-year bull market. I still believe that the absolute peak is still several years away. And this is again stemming from the fact the kind of reforms that have happened in India over the last 5 years, the transformation which is happened. We've seen the J curve of that. We're going to now basically see this kind of thing reverse, and you're going to see solid business momentum over the next several years, which will continue to translate into even a much more vibrant and a stronger bull market.
So are we in for a bull market like what currently is on in US? It's a 12-year-old bull market still alive and kicking. Every time naysayers have called the peak of the bull market, they've got eggs on their face. Are we in for that kind of a dream run? Why I'm asking you this, Nilesh? Very simple, because the history tells us that normally bull markets, they last 3 to 4 years at max. Are we in for more this time?
We could easily be in for more. And that's clearly because what today India has to offer is basically size, scale. We are a way bigger economy than where we were 10, 20, 30 years back. And the big advantage that India has versus, say, a US or a China is that if you look at the last 12 years of the US, it was a bull market driven by technology. In the past in China, we've seen a bull market driven by manufacturing. What I believe clearly going forward for the next maybe 5, 10, 15 years for India is that we have both sides. We have technology as well as manufacturing. And therefore, the kind of breadth of businesses which are going to basically grow in a pretty strong and a disproportionate manner, I think is much, much bigger than what maybe a US alone had or what China alone had. So clearly believe that a combination of technology-driven businesses, consumer-facing businesses, and manufacturing-led businesses clearly are going to basically have tremendously excellent times going forward.
Nilesh, for the bull market to go higher, earnings have to go higher. If earnings have to go higher, the shape of the economy will change. So if India has to go from 3 trillion to 5 trillion, what will be the shape of the economy? Because that in a sense will decide the next leg of outperformers and underperformers.
So what I believe clearly is that it's going to, the $5 trillion economy is going to have a significant contribution from different areas. But the sector which I believe, which today probably has just about less than 20% share in the overall economy, and that essentially is manufacturing, industrials. I believe the share of all of that is going to increase quite disproportionately, and that's driven by a lot of the reforms which have happened, which clearly directly benefit the manufacturing sector. increasing cost competitiveness, and the increasing need for global companies to de-risk and make India a very, very vital component of the global supply chain. So clearly believe that manufacturing will become a much larger part. Within services, clearly it looks like that technology-led businesses, digital businesses will have a much, much higher share versus what their share is right now. And therefore, all of this will get reflected in terms of their valuations, market capitalization, and share in the overall market capitalization as well. So clearly believe that it's going to be manufacturing-led and technology-led businesses which are going to thrive in a quite significant manner. And on top of that overlay, of course, those kind of consumer businesses which today are small, but with the help of technology and with the help of digitization, will become essentially be able to reach out to millions of consumers across the country in one stroke. I believe that those are the kind of businesses which are going to kind of grow disproportionately over the next several years.
But Nilesh, the thesis of how technology will change and how product stroke technology enablers will create wealth, isn't that in the price already? Tata Elxsi is at 6,000, LTTIS is at 4,800, LTI is at 6,100. The thesis is right. But aren't markets already pricing in not FY23 but FY24 and FY25 blue sky scenarios?
Well, optically, of course, the P multiples are surely challenging. I mean, these are not the kind of P multiples for these specific set of stocks which give you any comfort, as an investor. The upside, or essentially what probably is not factored in, is that, or maybe today we're probably still kind of looking at these kind of businesses growing at maybe say close to 15 to 20%. It's quite possible that some of these businesses, some of these companies could probably grow north of 20% for an extended period of time, because as these companies these companies are very different from where they were 5 years or 10 years back. The skill sets have changed, the competencies have become very different. They become hugely relevant for many more companies across the world. And that to me is probably a big, big opportunity where some of these businesses, which today are probably, just around $1 billion in terms of revenues, could become significantly bigger. They are not into the traditional stuff of application maintenance and development. These are basically the kind of companies which are creating those cutting edge solutions for their clients. And these clients are clients who want to adopt digitization and want to grow their businesses. And these kind of companies have the skill sets to create those digital solutions in the fastest possible time span. And that's where I believe is the opportunity. And these are kind of companies which are addressing very high growing sectors, be it healthcare, media, communications, consumer electronics. That's the kind of space, Internet of Things, and that's the kind of stuff that these companies are addressing. And therefore, I probably believe that maybe they can grow at a rate even north of 20%. If that were to happen, I wouldn't be surprised if in some of these cases, these high valuations sustain. Of course, that doesn't mean you may not have an intermittent correction. You will have an intermittent correction where some of the stock prices could get knocked off by maybe 15, 20% also. But that doesn't mean that the party is over in this kind of stocks.
So what is a justified P multiple, let's say, for IT sector? And I'll paint this scenario. 12 to 15% growth for FY23. Margins, they remain north of 20%. What is the deserving P multiple when you see this kind of a scenario? Because the scenario which I painted, Nilesh, I think is the most realistic scenario for FY23 or even FY24.
Well, so if that's the hypothesis, which means that growth rates of low teens and margins of maybe high teens, then I'd probably say that the current stock prices reflect what's going to happen in FY23 or FY24. But if you basically get to a stage where there will be a very limited set of companies which probably will deliver revenue growth in excess of 20%, and therefore will be able to cross the 20% EBITDA margin threshold and kind of have margins expand to 22, 23, 24%, the impact on the earnings growth is going to be stupendous. keep in mind that the biggies already have 25-26% margins. The likes of Infosys, TCS, they do kind of make between 25 to 28% EBITDA margins, if not EBIT margins. And if a handful of some of these tier 2 technology services companies who are into basically the new growth frontiers, if they end up growing close to 20% in terms of revenues and maybe and are able to manage to kind of get to 25% of EBITDA margin, if not in a year, but maybe over say 3 years, the impact on earnings, the impact on bottom line is going to be phenomenal. And that probably is yet not completely priced.
Some of your top holdings, Nilesh, they've done exceedingly well. Radico Khaitan, LTTIS, even for that matter, Carborundum. Have you locked gains? Have you booked gains in any of your holdings?
Nikunj, as we keep finding new ideas, we do tend to basically trim some of these winners, because as they kind of outperform and do extremely well in terms of absolute returns, we have been trimming our holdings in some of these names. But that's not because we believe that the best is over for them or anything like that. It's just that we basically, these are becoming now slightly larger positions of the portfolio. And as we keep discovering newer and newer investment ideas, we need to basically create liquidity within our portfolios to basically plow that money back into some of the new ideas that we keep kind of finding. So I think that's what we have been doing. So I'd probably say that maybe trimming a bit is the right word rather than a complete exit in these names.
So what have you been buying, Nilesh? Because if you're trimming, I'm sure you're not going to sit on cash.
Well, some of the names that we've added in recent times is across a diverse set of sectors. A few months back, we'd added Triveni Turbines. We really believe that the private sector capex is on a roll. And you're going to basically need, these kind of companies, and therefore Triveni Turbines really fits well in terms of a resurgence in private sector kind of capex. We clearly believe that the opportunity in real estate is there, and therefore within that, we've kind of added Canfin Homes, which is a housing finance company, a leader, especially very strong in southern market, which again are very, very good markets for housing finance business. And the most recent acquisition essentially has been in the consumer foods or the consumer snack space, is a name called Pratap Snacks, which we clearly believe currently is at the bottom of the cycle in terms of both demand as well as margins. But we clearly believe that as unlocking happens, as schools, colleges reopen, people travel, clearly we see demand coming back for a business like this. In addition to that, currently the margins are impacted because of high input costs, prices of palm oil, price of other raw materials, transportation costs, logistics costs. But we clearly believe that these are companies which are essentially reorienting themselves, bringing in about efficiencies, bringing in about productivity gains, and are bringing in and are altering some of their pack size, etc., all of that, and increasing the distribution reach, which will help these kind of companies to do extremely well over maybe a 2 to 3 year time frame. Prices are attractive from that perspective. So these are some of the names that we've been adding in the recent times. All these companies are pretty much relatively capital efficient, doing well in their niches, and therefore could essentially be significant outperformers going forward.
It's a great point. I just want to put perspective here for our viewers that Nilesh is looking into companies like Pratap Snacks because edible oil prices have gone through the roof. If you were not stepping out, you will not snack more. If you will step out, you'll snack more. It's simple human habits. And that's what I think Nilesh is doing. Buying stock at the bottom of the cycle. And when the raw material prices, they keep kicking in your favor because import duty reduction and the cycle has kicked in, the operating leverage and the margins actually would expand for them. Nilesh, are you keeping powder dry to buy any of the tech IPOs?
Not really, Nikunj, because I really believe that these IPOs get oversubscribed quite significantly. Honestly, the kind of allocation that you get is minuscule. So honestly, we're kind of giving it a pass in terms of participating in the IPOs. But I clearly believe that surely retail investors should participate in these IPOs. Some of these companies are going to, in a way, redefine the coming decade. And so to that extent, I would honestly suggest that investors do participate and have a share of the growing pie of these digital and tech-oriented kind of businesses. What we've been doing, Nikunj, is waiting for these companies to kind of list and see how they perform at the time of listing. We've done this in the last probably 6 to 9 months, where we've owned stocks like, we've bought into stocks like Angel Broking, we've bought into stocks like Ease My Trip, Matrimony. These are all companies which have IPO'd in recent times, and we've kind of seen very attractive entry opportunities on their listing or post-listing. And that's where we've basically stepped in and made them as part of our core portfolios.
Nilesh, you bought into AMCs also, HDFC and other AMC stocks. Given that now that space could see a wave of disruption because new AMCs are in technology based, do you think somewhere it's time to relook at the existing players? They may be large and they may be growing, but just like you bought Angel because the traditional brokerages were getting disrupted, what are the chances that top 3-4 AMCs which are listed now will get disrupted also, and time to get out of these stocks?
Well, Nikunj, disruption is a reality for every business in today's age and world. Times are disruptive, and therefore businesses will be disruptive. But my sense is that over a period of time, one has seen this, that leaders are able to transform themselves, especially in the services kind of business. The name that we have been owning is essentially a large player, a leading player called HDFC AMC, and we clearly see HDFC AMC being able to sustain its edge. It has to adopt a lot of technology-related initiatives to increase its reach and increase its connect with prospective investors. And because the pie is so large, I mean, in a country like India with 140 crore population, there are hardly maybe 2 to 3 crore unique mutual fund investors. I mean, that's still a fraction. I clearly believe that the pie is growing. The pie is large enough for maybe several more players. This is not basically going to be a business which is going to be restricted to a few players. And if I were to go back to the United States and see that if you own Franklin Templeton 50 years back, you made huge amount of wealth, huge amount of appreciation which has come to you over years, over decades, even when the industry's got a lot more mature. I clearly believe that India is still at the early stages. We are probably in the first 5 years of a 50-year journey. And therefore, if you have some of these leaders, you own them, you buy them, you own them and continue to ride. In addition to that, you look out for some of these newer players who are trying to kind of get into this space. And if they make sense to you, that can be fantastic. I mean, look at Angel Broking. I mean, yes, they moved from being a traditional brokerage to a online brokerage, a digital brokerage. They've been essentially doing exceptionally well, adding clients and all of that. And now they've set the sights on the asset management space where they've probably applied for a mutual fund license. And so you kind of keep your eyes open and keep watching the space. And when do you see that here there is a new player, a defining player, a player who's disrupting the status quo, you essentially be constructive on that as well. And if you believe that the name that you already own is not able to keep pace, I think one should be in a position to exit. So that's what we have been trying to do.
When will you sell, Nilesh? Because it's a cycle. Bull markets don't last forever. Bear markets will also last forever. One day this bull market will also come to an end. The idea is that you want to raise cash or change your stocks before we reach there. Because when the bull market will end, everything will come down like a Humpty Dumpty.
Well, that will have to be a very stock specific kind of an approach. I don't think one can really kind of take that in terms of a general market. I mean, of course, when the general market corrects, so will the set of stocks that you own will also correct. But what we try to do is to just take an individual stock specific view and see if the business is continuing to basically deliver. You keep owning unless valuations probably become totally astronomical or clearly kind of in a way don't leave any room for you from a 3 to 4 year perspective. So my sense is I still believe that these are early days, that one day is still kind of, I believe, far away. And therefore continue to be very positive, very constructive. We like the kind of companies that we own. In some of them, of course, valuations have become a bit stretched, but that's pretty fine. I think overall, from a portfolio point of view, we still continue to be very constructive and want to continue to own the kind of businesses that we own.
I'm asking this question, Nilesh, because everybody is saying that, look, we are not selling. We know stocks are stretched. Valuations are not at a comfort zone. So then why are you not selling?
See, Nikunj, it's like this, and I'd probably just point to a transaction which happened yesterday, or got announced yesterday, day before yesterday, TPG coming in and putting in $1 billion for Tata Motors electric vehicles business. I mean, that's honestly, that as a business is still in a very young and a nascent stage, but they have given the kind of valuations that they have given, which is significantly high. But nevertheless, that's the kind of capital which is still getting committed. Now, if private players can do that and they have the advantage of not having the ticker in front of them, probably we as investors in public markets need to kind of at least have an approach like that, where you say that these are kind of businesses which still have a lot of headroom for growth. And if valuations are probably higher from a traditional or from where we have seen them in recent times, if they are, a notch higher, I think that's fine. I think if earnings grow, if the earnings compound at a slightly higher pace, they will take care of the slight premium which is there in terms of valuation. I don't believe that this market is going to fall because of valuation. I probably believe that if at all there's a correction, it's going to be for some of the other reasons, which could be inflation or interest rates going up or liquidity tightening or some of these kind of challenges. Or maybe, yes, there could be earnings which will get impacted for a quarter or two because of challenges in the global supply chain and those kind of factors. But otherwise, I don't see demand being a challenge. I think demand is becoming a strong tailwind. And that to me is a big change, where demand actually was a headwind a few years back versus that there's a strong tailwind in terms of pretty robust demand. And that to me, I believe, is going to be a source of strength, source of earnings. And on top of that, of course, if the liquidity flow continues, I still believe that directionally we are heading for, we're going to be headed for even higher levels over a period of time.
So, Nilesh, the basic benchmark for the index return has been nominal GDP plus 3%. That's how markets have given you returns, which is about 13 to 15%. If one looks at that 13 to 15% historical return, can I safely say that by the time this bull market will end, we would be either above 1 lakh or closer to 1 lakh, which means is bull market में Sensex होगा 1 lakh?
Well, yeah, that's quite possible. It's very much possible. Of course, it's not something which is going to happen tomorrow, day after. It's obviously going to take a few years. But that's very much possible. And that's only going to be a number, that level of 1 lakh for the Sensex. Honestly, these two, several years back, we used to think when it becomes 20,000 or 30,000 or 40,000. I remember the last bull market, which was the 2008 bull market, where the Sensex had peaked at 21,000. Here we are, 12 or 13 years later, we are at 60,000. But if I were to kind of look at it in context of 60,000 versus the 21,000, 13 years back, that's not yet a great number. We probably should be a lot higher. So my sense is that yes, and that lot higher surely will be around that 1 lakh number. The question is whether that number is 3 years away or is it 5 years away. That's essentially the moot point. But otherwise, there is a very high certainty to that 1 lakh number.
What could pour cold water on all our assumptions? Could it be China? Could it be crude? Could it be the energy problems which are coming up?
It probably will be maybe all of them. That's going to be the worst case scenario, where everything just comes up together, which is Fed increasing interest rates, inflation, crude, China. These are all the bunch of factors which could essentially always play the spoil sport. But even in the past, we saw this situation. If I were to kind of go back to the previous big mega bull market, which was the period of 2001, the lows of 2001 to the highs of 2008, That was a bull market which lasted for 6 to 7 years. And of course, in between, we had some massive corrections. I mean, 2004 was when I remember the markets had hit a lower circuit. 2006, again, there's a huge sell-off in emerging markets. And there was a huge correction for maybe a month or two. And there was maybe correction which was to the order of 20-30%. These are things which will happen. But I clearly believe that the economy is positioned at a point of time where I think it is headed for much stronger growth. We've been so used to the 5-6% growth. If basically we have an economy which grows between 7 to 9% range for a period of 5 years, the impact on businesses is going to be phenomenal. It's going to have a way more broad-based impact. And what you will actually clearly see is a lot of sectoral rotation happening. You're going to see a huge increase in terms of the number of companies that you could invest in. Your choice expands, and all of that. So my view is that yes, corrections will happen. There will be. That is going to be very normal and very natural phenomena in the markets. But net, we will still overcome those kind of corrections and scale even higher peaks in the next several years.
Sounding bullish as ever. So final question. We've known each other for almost 20 years now. So I know that your son is a maths whiz. He's studying computer science in the US. What are you telling him to focus on in terms of future technologies? Where do you think he should scale up? I'm being asked this question by a lot of people, that which are the future businesses where one should study and one should take a leap of faith.
I clearly believe one very exciting business going forward is going to be the SaaS space, the software as a service space. Clearly, you pay as you use is basically becoming the new mantra, and that's exactly what SaaS stands for. Clearly, every service, every software eventually is a service, and basically you get your users, your customers to pay as they use these services. And clearly believe that that is going to be a huge opportunity. I mean, clearly already Snowflakes has already defined the space. Freshworks from India has gone ahead and listed. And these are kind of businesses which will probably grow at maybe 30 to 50% CAGR for the next 5 to 10 years. And they have a very strong chance of becoming multi-billion-dollar businesses. So if I were to kind of really bet on one theme over the next 10 years, I would probably think is that SaaS is going to be a very, very defining theme for this decade.
Well, fantastic to have you on this series. We've covered a range of topics on what you like, what you don't like, what is a 10-year advice from a father to a son, or in this case, I would say from an investor to somebody who wants to, let's say, advise somebody to start a new venture. Appreciate your time. Stay safe, and certainly hope to see much more of you going forward.
Thank you. Thank you so much.